Hello and welcome everyone for this monthly fixed income outlook video where we try to decipher what is the outlook going ahead within the global and domestic fixed income market. For this discussion, we have with us Mr. Basant Bafna. He's head fixed income at Mirae Asset Mutual Fund. Welcome, Basant.
Happy to be here.
Yeah. So last 1 month, Basant, we have seen it has been quite eventful in terms of various developments which are happening in the global space, be it tariffs and geopolitical uncertainty, flare-ups that we are seeing in the Middle East. There's been a lot of uncertainty. Uh, Given this backdrop, if you see the U.S. Treasury yields, they have ranged from right from 4.24% in January end to 3.96% in Feb end, and now again they have moved up to 4.09. So, given this backdrop, how do you see the U.S. Fed FOMC, which is scheduled later this month? What could be the outlook and guidance that you are expecting from that meeting?
So, if I break the question up in two parts, see, the first thing is on geopolitical developments, and the second thing is on tariffs. So, in terms of the geopolitical developments, there is a key movement that has happened in oil prices, including the possibility of significant flare ups going forward as well as flare ups in LNG as well as LPG prices. So from that perspective, there is a possibility of high inflationary impact globally as well as domestically, and that's something that concerns all developed as well as emerging market economies. Within this, so generally the rule of thumb domestically is that every 10% rise in oil prices results in between 25 and 30 basis points impact on inflation and 30 to 35 basis points impact on the overall current account. So we are closely monitoring this, but yes, if this prolongs, then the impact on inflation may be significant. So on the second part, which is the tariffs, we are all aware that IEEPA tariffs have been struck down by the Supreme Court in the US. Uh, but as an alternative, a 10% universal tariff has been implemented with the possibility that within the legislation there is a possibility of increasing these tariffs to 15%. There are a couple of other alternatives also that are available, but clearly the kind of impact that the overall tariffs have had in terms of the overall revenues stream for the US, it was quite significant, and refunding that may have a significant impact on the overall fiscal dynamics, and that's why you see an upward movement in US treasuries. So first part of the movement, which was the downward movement, was safe haven demand, but followed by that there has been fiscal dynamics coming into play, and because of that you've seen an upward movement in overall yield.
Sure.
Now going forward, the issue is that if this continues to remain struck down, while the US government has requested for extensions as well, but if it continues to remain, then there will be a lot of operational issues also which might come up, because the initial impact of tariffs partially has already been borne by consumers. Right now, how do you track down those consumers if corporates who have paid the tariff and in turn passed it on to consumers, then if you get the tariffs back, then do you give it back?
Too much of operational
Challenges will kick in.
Right.
So a lot of things to look out for,
Right.
but I think this is something that markets are clearly looking at. But with all of that, with the uncertainty which is there on the fiscal as well as on the inflation front, as well as in terms of the overall job markets, which are quite stable right now, the
Right.
possibility of rate cut may not be there in this policy meeting.
Okay.
Our base case is that there will be a pause in the policy meeting, and perhaps FOMC will wait for further data to decide on their future outcomes.
So you touched upon how it will impact even the domestic macro environment, be it CAD, be it inflation, and I suppose even the currency will be under pressure. That is what we are seeing in the recent movements as far as USD INR is concerned. So moving to the domestic macro environment, so recently in Feb we saw the new GDP series coming in. Data for January for Q3 FY26 was released, which came in at around 7.8%, which was slightly better than what was expected by the markets. At the same time, we also saw CPI for January 26 released under the new series, which came in around 2.75% versus 1.33% in December. So, what do you make sense of all this evolving inflation growth dynamics, how this will pan out, and how would RBI, in terms of the further monetary easing, how will RBI take into stride all this and whatever is happening in the global space?
So global space, like I mentioned, becomes a key monitorable. But with that, the pass through on inflation is not like to like, because a large part of retail consumption in terms of fuel is regulated. So from that perspective, the pass through may not be similar. In terms of the overall growth inflation dynamics, the new print reaffirms the fact that we are in a phase of strong growth with stable inflation. So 1 year ahead inflation continues to remain in terms of overall expectations at somewhere in the range of 3.8 to 3.9%, which essentially means that as a base case you look at a prolonged pause. However, the overall transmission has not been the same as it has been for term loans for banks, given their uh, proximity to the external benchmarks. So that has not been the case for debt markets. Now, from that perspective, the focus of RBI has remained in terms of actions. Also, we have seen that it has remained on transmission of liquidity, and for that they have done significant amount of interventions in the form of buy sell swaps, in the form of open market operations, on screen as well as on a scheduled calendar basis. Now, from this overall perspective, we've seen that overnight rates have ranged below the overall LAF corridor, which is between SDF and MSF rates. So, overnight rates have consistently been below the SDF rates. And with that, we've seen some sort of transmission starting. So, as a background, perhaps 1 year CDs have fallen close to 5 to 10 basis points. It had fallen significantly higher, close to 15-20 basis points, and it has inched up a bit post the geopolitical developments. But clearly, the curve has flattened, and therefore, from investment perspective, we like the 1 to 3 year part of the curve the most, because that is the flattest part of the curve. And as and when you start seeing liquidity driven transmission, which we expect perhaps in April, with that, we will perhaps see curve steepening once again, and with that steepening, this part of the curve may benefit the most.
So, you already spoke about how the fixed income market reacted over the last 1 month. I guess long end has been sticky for some time now. So, given that perspective, where should investors allocate their money from a risk reward perspective?
So, from a risk reward perspective, investors should always look at their investment horizon and try and align the investment horizon with the underlying duration of the specific funds that they are considering. Having said that, as I mentioned, the sweet spot remains the 1 to 3 year part of the curve. On the sovereign side, in one of our previous calls, we had mentioned that 5 x 10 spreads look attractive, and they've sort of widened from there. So, from that perspective, now we are starting to like the 10 year part of the curve, given that 5 x 10 spreads have widened significantly, and interventions are also continuing in that segment of the curve. But overall, say for example, if you have a 3 month to 5-6 month investment horizon, you look at a 6 month product. If you have a 6 month to 12 month investment horizon, you look at a perhaps a 12 month sort of a product, and so on and so forth. But at this moment, the sweet spot remains the 1 to 3 year part of the curve.
Thank you, Basant. Thanks for such an insightful session. Hope our viewers would have benefited from this. We look forward to your participation. In case if you have any feedback, do share with us. Thank you very much. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.